All right, guys. So I just want to remind you that us studying tonight and me kind of going over my notes, that is all this is. I am going over my notes with you. I was a C student, high school and college, so just getting things very easily never came very quickly to me. I had to learn how to study. And in anything that you want to be great at in life, there's going to be a process to it. And so I just want to encourage you to stick with the process of learning this life insurance deal, really understanding it so that you can do well on your test. And know that it's going to be worth it, right? You're not going to have to keep retaking this test every year or anything. Once you get this thing, you knock it out, you're good. So I want to encourage you to stick with it. We're going to talk today about provisions, options, and riders. So this conversation that we're having is not going to replace you studying. It's not going to replace the 20 hours you got to spend in class. But it hopefully will help you score some extra points on the test. And that's my goal, is to see people pass. And so do me a favor and mute your phones. And then if you have a question, just feel free to interrupt me. And for you guys that are on YouTube, feel free to make a comment under the video. And I'll try to check back at the comments and answer your questions as best I can. All right? So I want you to think about policy provisions as sections, right? So when you think about when you were in English class in school, there were an outline, right? Here, Roman numeral 1, Roman numeral 2. That was standard, right? You never saw Roman numeral 5 come before Roman numeral 1, right? So you want to think about the provisions of the contract as being standard. So the National Association of Insurance Commissioners kind of came out with these couple standard provisions, right? So every time you see NAIC, that's what that stands for. The National Association of Insurance Commissioners. All right, so that's the provisions create uniformity. So you want to think about an outline. Roman numeral 1, Roman numeral 2, Roman numeral 3. Let's talk about the first one that you're going to encounter. It's called ownership. Ownership. So not the beneficiary and not even the insured. I want you to write down a short version of what I say. Okay, y'all ready? Ownership. This is the person who makes decisions about the policy. They make the payments. They can name the beneficiary. That's the person who has ownership. They make decisions about the policy. They can name the beneficiary, and they pay the premium. Now, I want you to remember and write this down. The policy owner does not have to be the insured. The policy owner does not have to be the insured. So it could be two different people. And when you think about it like this, let's say that I have life insurance on my son. I am the policy owner. I make the decisions, I pay the premium, but he is the insured. All right? So the owner can also determine who the beneficiary is. The beneficiary is the person that gets the check upon the insured's death. The beneficiary gets the check upon the insured's death. So let's talk about assignment. So you can assign ownership of a policy to somebody else. Let's talk about the first type. It's collateral assignment. Collateral. It's just like using collateral for a loan, for example. It's temporary. So the book, I believe, says temporary partial ownership. So I want you to think about this example, and I want you to write a little note for yourself to remember this example. You walk into a bank and you say, hey, bank, I need $300,000. And the bank says, we love your idea. We'd love to loan you the money. But if you die tomorrow, how are we going to get our money back? And you say, well, I have a $300,000 life insurance policy. Temporarily, I'll assign it to you. You become the owner. And then after I've paid the loan back, I can come back and reclaim my policy and become the owner. Okay? So that's collateral assignment. All the rights are returned to the policy owner at some point. Absolute assignment is like if I say, well, I have this life insurance policy over here and I want to assign it to my son or my best friend. I've absolutely given it over to them. It's permanent. Absolute. So full assignment. Absolute assignment. Okay, you see how those are different? Any questions about that? It's a permanent and total transfer. I want you to make a note that the new policy owner does not have to have insurable interest in the insured's life. But let's talk about and kind of recap what insurable interest is. Next to insurable interest, I want you to write, I lose something if this person dies. I lose something if this person dies. That's one of the quickest ways to measure whether or not someone has insurable interest in the insured's life. Another provision is the entire contract provision. I want you to think about an insurance policy as being a document, a living document. And the application plus the policy equals the entire contract. So both pieces come together to make the entire contract. Everything that's stated in the application and everything that's issued out in that policy all make up that legal contract. All right. Modifications. So any changes that happen to a policy must be signed. And they are attached to the original. That's all the modification section talks about. So neither the insurer nor the insured can alter this policy once it's in effect without both parties agreeing to it. And then you have to fix it to that contract. You have to attach it to the original contract. Okay? Payment of premium. So your premium is due in advance. Per this contract, you're saying I will pay my premium in exchange for this guarantee of coverage. So premium needs to be paid in advance. Now when you get a policy issued, here's another provision we're going to talk about. It's called the free look period. Free look period. And so when I was memorizing everything and kind of situating it in my head, I would write around and I would say 10-day free look period. That's just how I memorize it. That's how I want you to memorize it. Once that policy is issued, the client has 10 days to look at it and make sure they're satisfied. They can return it and not pay any fee to get all their money back. That's why it's called a free look. No charge, no surrender charge for returning that policy. So 10-day free look period. Next, we're going to talk about the grace period. 30-day grace period on individual policy, and I want you to write 31 next to group policy. And again, I want you to kind of think about what does this mean, right? If I give you grace on something, let's say you come in past your curfew and you're my child, and I say, you know what, baby, I understand because traffic is bad. I've given you grace, right? I've excused you from it. That's the same thing. See, under the previous provision we talked about, it said that premium payments have to be paid in advance. But if the company gives you a grace period, that means they're not holding the next 30 days against you. They won't drop you just because you're right under the mark of being late. Now, once you go over that 30 days or over that 31 days, that's when you're in trouble. But they give you that grace period. That's all that means. Reinstatement is another provision. Reinstatement is just like it sounds. If something was instated, you are reinstating it. And so what I want you to memorize about reinstatement is 3-year reinstatement. And when I would study, I would use these kinds of things. I would, use my fingers, use my head, I would use my body. Why is that, y'all? Because the more pieces of yourself that you engage, the easier it is to memorize something. So you may look a little corny, but you're going to make some money. You're going to be able to help a lot of people. I think it's worth it. So take these tools and tactics to heart when I say whatever it takes to get this ingrained in you, even if it means riding around listening to it all day, it's worth it. It's absolutely going to be worth it. So that 3-year reinstatement period, all that means is that 3 years after a policy lapse, it can be reinstated. Now, the question on your test may ask, why would you want to reinstate an old lapse policy? Well, one reason is because the age and the guarantees are retained. They're kept in that old policy. So a person doesn't have to start over from scratch. I want to make note that they may be required to repay any outstanding loans plus interest. They have to pay any back premium. They have to prove insurability. I want you to remember those. Paying any outstanding loans plus interest, pay the back premium, and prove that they have insurability at that point. But that policy can be reinstated. So the old cash values, that lapsed policy could be put back in force. Incontestability, right? So if something is contestable, it can be challenged. If it's incontestable, that means it cannot be challenged. You cannot rise up against it and say, no, I'm not paying. That's exactly what this is saying. The company cannot contest paying your policy once you've had it for 2 years. So just like I wrote around saying 30-day grace period, write around saying 2-year incontestability period. So during that 2 years, the company can investigate. After that 2 years, it doesn't matter. They got to pay it. Okay? During the first 2 years of a policy, the company can say you did something that was misleading or borderline misrepresentation. After the 2 years, they need to pay, unless it was some fraud or something like that. Okay? Misstatement of age is another thing. Misstatement of age. So let's say that I lied on my policy and I said that I was 30 years old, but I'm really 33. The company would adjust the payout, but they would still pay. That's all you have to remember about misstatement of age or gender. The company will adjust the payout to match what they would have paid for somebody that age, or what they would have paid for somebody that gender. Misstatement of age and gender. Okay? Settlement of death benefit. Settlement of death benefit. What I want you to remember about Louisiana is the death benefit must be paid out within 60 days, or the company will have to pay 8% interest. Okay, and that's how I memorized it, driving around a 60 or 8. I wrote around saying 60 or 8, 60 or 8. And that will, if you truly memorize the rest of it, that will become a brain trigger for you. They got to pay it within 60 days or they pay 8% interest. And that's the penalty. Okay? Interest on the benefits of life insurance begin to accrue 20 days after the receipt of the claim. So after you've proven the loss, after you send in that death certificate, 20 days after that, the company will have to start paying that 8%. All right. Exclusions. Next to exclusions, I want you to write WASH. W-A-S-H. WASH. The W stands for war and acts of war. So any acts of terrorism or war could technically be excluded. For example, there are some companies that did not pay out during 9/11 because it was technically an act of war, an act of terrorism. And so that exclusion was activated for them. Okay? All right? So war. A is for aviation. Next to aviation, I want you to write flying your own small plane. So if you drop out the sky flying your own small plane, they don't have to pay. If you die during a commercial flight, the company does. But aviation, personal plane deal that you're flying, your kind of deal, doesn't have to pay. It's excluded. Okay? The S is for suicide. But within the first 2 years, if you commit suicide, the company does not have to pay. It can be excluded. Suicide. And the H is for hazardous hobbies or occupations. Hazardous hobbies or occupations. So if you are a base jumping instructor who skydives every week, then they may not have to pay. Okay? So those are exclusions or WASH. Stop me if you have any questions. Let's talk about beneficiaries. So beneficiaries are designated differently. And I want you to remember this. The beneficiary is the person or the interest that gets the check when you die. That's all I want you to remember. Because when you think about it, if it's a person, it's a human. If it's an interest, it could be a nonprofit. It could be a business. It could be a trust. It doesn't matter. It's the person or the interest that's going to get the check when you die. So let's talk about who the beneficiary could be. Okay? it can be paid directly out to anybody except a minor. The beneficiary, if the beneficiary is a minor, they cannot accept the check directly. The money will be put into a trust for them, or there will be a guardian named for them. So it's kind of number one. Can't be a minor. Okay? Next, I want you to write down the beneficiary does not have to have insurable interest. The beneficiary does not have to have insurable interest. And there's some test questions that can be a little bit tricky on that. Now, let's say that the owner of the policy names multiple individuals to be the beneficiary. So I may have two primary beneficiaries. I would have to designate a percentage next to each. So just remember that. Both people can't get 100%. It's got to be 50-50 or 60-40 or however I designate. Okay? The different classes of beneficiary. So under beneficiary, I want you to write classes of beneficiary. All right, so I might check a box that says all my children, and I want the money to go to all my children. And I might have multiple kids. They can be per capita, by the head, or per stirpes, by the bloodline. And that's literally how I studied, y'all. Again, every part of your body that you can engage to help you memorize this, do it. Per capita is by the head. So that means if I have Mozzie and Trey are my two children, and something happens to Trey before I pass away, if I designate it per capita, all the money goes to Mozzie. Doesn't matter if Trey has kids and survivors and a wife and all that, doesn't matter. Per capita means by the head. Per stirpes is by the bloodline. So same case, I have Mozzie and Trey, but if I designate it per stirpes, or if it's drawn per stirpes, then that means Mozzie's money goes to him because he's still alive, but Trey's money, since he's gone, is going to go to his kids. So the money follows the bloodline. What I want you to write under that is the money follows the bloodline of the beneficiary. So it doesn't matter if it's, my stepchild, or if it's, my sister's child, or none of that's going to matter. It follows the bloodline of the beneficiary. So it's either by the head of the named beneficiaries or by the bloodline of the named beneficiaries. And that can be a little bit tricky sometimes. If there is no beneficiary named, then the check will be cut to the insured's estate. If there's no beneficiary named, the check will be cut to the insured's taxable estate. All right, let's talk about succession. So there are levels of beneficiary. There's your primary and your contingent beneficiary. The primary is the person who gets paid first. If they're still alive, they're getting paid. The contingent, I want you to write it down just like this and read it to yourself every night before you go to sleep, every morning when you wake up. If you read a short version of your notes, it'll really help stick in your brain. The contingent beneficiary can only be paid if the primary is dead. The contingent beneficiary can only be paid if the primary is dead. So the contingent beneficiary is second in line. Okay? So there's revocable beneficiaries and irrevocable. Same way as if your parents said, you know what, I'm revoking your phone privileges. They took them away. It's the same way with beneficiaries. If you have a beneficiary on your policy that is revocable, revocable means I can take their right away. Irrevocable means I can't take it away unless they say yes. And so sometimes you may see this like in a case where a family member is dealing with dementia or Alzheimer's, and they want to make sure that if they're ever out of themselves, that they can't name somebody else the beneficiary. So they may list their beneficiary as irrevocable. That way that beneficiary can step up and say, no, I don't consent to moving off the policy, to moving out of that beneficiary spot. So that's irrevocable. Let's talk about the common disaster clause. This one can sometimes get tricky for people. So I want you to think about the primary beneficiary and the insured get hurt in the same car crash. That is a common disaster. And based on this clause, The court system will look at it as if the primary beneficiary died before the insured. The primary beneficiary died before the insured. So I want you to write it like that. Every time you see common disaster clause, know that the law treats it as if the primary beneficiary died before the insured. It doesn't matter what happened in real life. That's how they treat it. Let me tell you why. So let's play it as if it really happened in real life this way. You have the primary beneficiary and the insured driving down the road. They get into a really bad car accident. The insured dies immediately. Where's the money going? When the insured dies immediately, that death benefit is going to the primary beneficiary. And then let's say that that primary beneficiary dies a week later from the accident, still from those complications. Will the insured's money ever make it back to his contingent beneficiary? No. The money would actually, since it's already been taken in by that primary beneficiary, it's going to go to their family. And so what happens to the insured's family? They're left out. And so the court system set it up so that it would automatically be assumed that the primary beneficiary is gone, which means the contingent beneficiary can now collect the insured's death benefit. Okay? So what you think about it is a way of protecting survivors, and that'll help that one make a lot more sense to you. The spendthrift clause. So when this is in a life insurance policy, it means that the beneficiary is not at risk of creditors coming back to him and say, hey, we know you just got that big check from Uncle Larry dying, and we want our money. Spendthrift clause. Companies cannot do that. Debtors cannot do that. Policy loans. Very interesting. I want you to remember that if there's a policy loan involved, it's a cash value policy. A term policy will not have a cash value, so there will not be anything to borrow. The policy loan amount is going to be the cash value that's available. Okay? If there's any outstanding loan when the insured dies, the amount of that loan and the interest will be deducted from the death benefit. So that loan and that interest will be deducted from the death benefit. Policy loans are not subject to income taxes. Policy loans are not subject to income taxes. All right. Automatic premium loans. So I want you to think, and on this test, I want you to use your brain, but don't be too smart, because some of the stuff you're going to read in this book will be like, well, that's dumb, or that makes no sense. Listen, memorize it the way it is in the book. Learn it the way it is in the book. Don't try to make sense of the concept. What I want you to think through, when you keep some things in your brain, be like, what do these words mean? When I put this together, what is this about? Or what benefit could this have? And that'll help you to figure out the answers to a lot of the questions. When you talk about automatic premium loans, why would the company want to automatically loan you some money on your premium? To keep the policy in force. And where does that money come from? Your cash value. So the purpose of an automatic premium loan, the company allows money from your cash value to be moved to pay the premium on your policy to keep the policy from lapsing. Automatic premium loan. Withdrawals or partial surrenders. I want you to always think about universal life. When you hear about withdrawals and partial surrenders, it's UL policy. I want you to think about it. Okay? So there are usually limits as to how much can be withdrawn from that UL policy. And so your test question may ask you something like that. It won't necessarily ask you for the dollar amount. It will ask you, are there limits? Okay? So let's talk about riders. We talked about provisions already. Let's talk about riders. Now I have something that I think may help you. Right here, I have a charger. Okay, charger cable. I want you to imagine that this is the life insurance contract. A rider is an attachment. It modifies the policy. So if I put a wall plug on this cable, it becomes a wall charger. If I put a carport plug on here, it becomes a car charger. Riders are like that. Riders attach to the policy and they modify it. They change it in some way. So I may have a disability rider. Disability rider. Okay? Remember we talked about the provisions of the contract. One of the provisions of the contract said premium must be paid in advance. But if I have a disability rider, and it's called waiver of premium, if I attach that waiver of premium rider, what is it waiving? The premium. So that means my contract might have said I need to pay all of my premium in advance, but the rider that is attached to that contract, it changed that. Everybody good on that? So waiver of premium, just like it sounds. It's waiving that premium. Okay. Usually there's a 6-month waiting period. You have to prove that you're still disabled. You have to pay during that 6 months. After you've paid, the company will say, you know what, we're going to give you all the money back. You continue to be disabled, that's fine. Okay. So waiver of cost of insurance. I want you to think about your universal life policy in this case. In universal life, there's a cost of insurance. That piece of the premium you send in is only going toward the insurance. It's going to go up every year as you get older. So it goes up with your attained age. So let's say you're like, I am disabled, but I still want to accumulate the cash in my universal life policy. You're not going to worry about the waiver of the cost of insurance. You're not going to worry about the cost of the insurance that's there because you have a waiver for that. But you still would have to put some money in to get the cash value out of it. That's how universal life works. So waiver of cost of insurance, I always want you to think about a universal life policy on that one. Because all it's waiving is just that cost of insurance. It's not waiving the money that's required to accumulate cash. All right. Disability income rider. Okay. Your standard contract says you owe the company some money every month. The disability income rider attaches to that and it modifies it. And so now all of a sudden they owe you some money every month. Again, it's just like it sounds. Disability income. It pays you an income if you become disabled. So that's what I want you to write next to that one. Disability income rider pays you an income if you become disabled. All right. Now there are riders that cover the additionally insured. So this is like riders most people are familiar with. These are attaching to the policy, they're covering more people than the original policy covered. Okay. Spouse or other insured rider. It's going to cover the spouse usually up until a certain point. So it may be, it covers the spouse age 65. Now that spouse is insured attached to your policy, or it may cover the kids. Children's term rider. It allows for children's natural, adopted, or stepchildren to be covered for a limited period of time, usually till about age 21. Okay. Not all companies are exactly the same on that one. All right, family term rider. Usually these are converted to whole life. It's term insurance that is then attached to a whole life policy that covers those family members for a term. Remember, every time we see term, we're talking about a period of time. So that coverage lasts for a period of time. Okay? There are riders that affect the death benefit. One is called the accidental death rider. Now, usually this rider will expire at age 65. So that's the first thing I want you to write. Accidental death rider may expire. at age 65. Let's talk about how that works. Usually it's going to be double indemnity or triple indemnity. And you could be under your desk at the test and you're like, okay, let me think about this. Double indemnity or triple indemnity? Whatever you got to do to pass. Double indemnity just means that the policy is going to cover you double the face amount if you die as a result of an accident. One of the things you have to note about this is that the death usually must occur within 90 days. It has to be directly related to that accident. Any questions on that? Some policies are going to pay triple indemnity. Okay? To indemnify simply means to make whole. So it means giving you back what you lost. All right, the guaranteed insurability rider. So this allows you to purchase additional coverage. So you're adding on to your policy usually up until a certain point. And they allow you to add that extra coverage without proving insurability. That's what the waiver is called, or that's what the rider is called. I'm sorry. The rider is called guaranteed insurability, and it's just how it sounds. You're guaranteed to be insurable up until that certain point, usually it's around 40. Cost of living rider. It also affects the money, right? Because this death benefit is going to go up based on the cost of living. All right. Usually the inflation index, let me help you make a note on that one too. The consumer price index, or CPI, is usually what's used. Consumer price index. All right. The accelerated benefit rider. Let's talk about how that one works. So the death benefit comes out when you die. So if it comes out any sooner than that, it's when you're alive, right? And so usually it's the result of some terminal illness, really bad diagnosis that happens. And you generally can get up to a certain percentage out of that policy while you're still alive. So part of that death benefit's paid out while you're still alive. That's accelerated death benefit. And then the long-term care rider. It also allows for early payment. Usually it'll say that if you are confined to a nursing home, a nursing facility, that you can take money out of that policy, no surrender charge, in order to provide for your care. All right. So if an insured withdraws a portion of the death benefit during the rider, that part's going to be deducted from the end result of the death benefit. Usually there's some sort of policy fee, like $75 or $150 for processing that paperwork. But just always remember that if the problem requires you to do some math, just know that if I borrow $20,000 out of a $100,000 policy, I have $80,000 left. Okay? All right, let's talk about options, and then that will be it for the evening. Options, okay? Every time you think about options, I want you to think about how the cash value gets paid out. Options, how the cash value gets taken care of, or how it gets paid out. Okay? So with cash value policies, I want you to remember this term, non-forfeiture. You cannot forfeit this money. There's certain guaranteed value built into this. Guaranteed monetary value, shall I say, built into that premium, built into the policy. All right. So I want you to remember the acronym REC, R-E-C, REC. First, that money, that cash value, can be used for reduced paid up insurance. On your test, you're going to have scratch paper. I want you to use it for your highest good. And that might mean writing down things like REC and WASH. So REC, the R is for reduced paid up insurance. That means you would use the cash value to get a new policy that is reduced face amount from what you previously had. It'd be paid up. It's reduced paid up insurance. Okay? So people can then use it to purchase a single premium term life policy if they want. And then the E is for extended term. Usually this is the automatic choice of a lot of companies, extended term. All right. So this means they took the cash value out of the policy and bought term insurance for however long, however much time could be purchased for that amount of cash value. All right. So that's extended term. And the C is for cash surrender value. And it's just like that. You surrender the policy to them, they give you a check. Cash surrender, right? So you're surrendering it for the cash that is built up in it. Okay, so that's rec. All right. Last, we're going to talk about dividend options. So for those policies that pay a dividend, that dividend money cannot be forfeited. You can't just leave the dividend money at the company. Something's got to be done with the money. Okay? So next to dividend options, I want you to write CRAP 1. Dividend options, CRAP 1. All right. So the C is for cash payment. So you can get the dividends as cash. Technically, they don't send you a check. They're going to send you a check. So cash payment, you can get the dividends as cash. The R is for reduced premium. So next year's premium is going to be reduced. You told them, you know what? Take that dividend money, apply it on my next year's bill. So that's the reduction of premium. The A is for accumulation at interest. That means you left the dividend money there. It's been sitting and it's building up interest. Accumulation at interest. Excuse me. You're going to pay taxes on it the year that it gains. You're going to get some interest. You're going to pay taxes on it. The first P is for paid up additions. It's purchasing additional insurance, but it's paid up. So let's say that you had $1,000 worth of cash value and it bought you $20,000 in insurance. That $20,000 would be paid off. That's paid up additions. And then you have paid up insurance. Paid up insurance means I'm paying my current insurance up early. Paying my current insurance up early. All right. So instead of paying till age 100, I'm going to use the money so I can pay it off sooner. And 1 year term. That's where the 1 comes in. Or some people say CRAP 1. That 1 year term. You could take the money that's left in that policy, you can drop it into some term insurance and buy 1 year of that term insurance. So it would be added on to the whole life policy in this example. Okay? And then you have settlement options. Every time you think about settlement, I want you to think about how the death benefit, how that check is going to come out. Settlement options. How the death benefit gets paid. CLIF, C-L-I-F-F, is the acronym that I want you to write down for that. CLIF, C-L-I-F-F. The C is for cash payment. All right, so we know that that's just going to be some cash that's going to be given. The L is for life income. So you could decide the death benefit will be paid annuity style, where there's a payment that this person cannot live out. They cannot outlive, shall I say. And then the I is for interest only. Some companies actually choose this for clients who aren't paying attention. But the client is just going to get the interest payment on that money. So they're not going to get a lump sum payment. Okay? The first F is for fixed period. So imagine the insured sets this up so that the beneficiary gets a check for a certain period of time. So they may get $800 check for the next 30 years. And then you have fixed amount. It's the other F, is fixed amount. And that's where the insured determined, hey, I want the death benefit to get a certain amount of money. Okay? So the recipient is usually the person who's going to select that amount. That's fixed period, and that's fixed amount. All right. So that's pretty much it on what I have for you guys. Definitely email me, thepurposefilledwoman@gmail.com, if you have any questions. Leave comments on the video. I'll try to cycle back and make sure that I address those. And just, let me know. Hopefully this was helpful. But definitely let me know if there's some areas that you need me to go over, because I can just make another video for that.